Chelsea opens her banking app on a Tuesday. $41,000. She scrolls past it to the one line she has never read. Interest earned last month. 34 cents. That same 41,000 in a different account would have paid her $143. Same access, same insurance, same risk. 400 times the money. Her friend Silas has the same $41,000. He got the 143. Nobody broke a rule. There's no hidden fee. There's no fine print anybody buried. It's all disclosed in public on a page you have never opened by an institution that is not hiding from you and never was. The whole thing works because your bank knows something about you that you don't know about yourself. They know how long you'll leave your money sitting there before you get around to moving it. For the average American, that number is 19 years. 19 years in the same account, at the same rate, for the same 34 cents. My name is Nick. I've spent an unreasonable share of my adult life reading bank disclosure documents so you don't have to. Today we're finding the actual maximum you should ever keep in a bank. Not the number your bank wants. Not the number your uncle shouts across the table at Thanksgiving. The real one. Subscribe because there are two separate ceilings here and almost everybody worries about the wrong one. And stay to the end. I'll give you one question to ask your own account tonight that answers this in about 11 seconds. Let's define the problem properly because it's usually framed badly. When people ask this, they're asking about one number, $250,000, the FDIC limit, the famous one. It got dragged onto television in 2023, when 3 of the 4 largest bank failures in American history happened inside 8 weeks. That number matters. It's messier than you think. We'll take it apart. But almost nobody watching will ever touch it. The other ceiling is the low one. Nobody puts it on a poster, nobody writes a news alert about it, and it's costing you money this month, while you sit there feeling responsible for having a healthy balance. 2 ceilings. One protects you from your bank failing, the other protects you from your bank succeeding. There's exactly one situation where blowing past both is correct. That's where our third character comes in. Lorene has $400,000 in a single account at a single bank. She is doing nothing wrong. I'll come back to her. Lorene's situation is the exception, and exceptions only make sense once you know the rule. So let me just give you the rule now. The number. Then I'll spend the rest of this proving it. 2 months. 2 months of your expenses. That's the maximum that belongs in your checking account. If you spend $3,400 a month, that's roughly $6,800. Enough to absorb a bad month without you ever thinking about it. Underneath that headline number sit 3 tiers. 3 to 6 months of essential expenses in a high-yield account, not in checking. $250,000 as your absolute ceiling in any one bank in any one ownership category. And money with no job for 5 years or more, which shouldn't be in a deposit account at all. That's the whole answer. It fits on an index card. Now here's why almost nobody follows it and why the cost of ignoring it is so much larger than it looks. Start with the low ceiling because that one has your name on it. Inflation over the last year ran about 3.4%. The national average savings account pays about 0.38%, and the 3 biggest banks in America pay 1/100th% on standard savings. 1/100th%. On $10,000, that's $1 a year. You'd do better checking the couch. The couch pays you regularly, but it has no minimum balance. Now hold those 2 numbers next to each other. 3.4% inflation. 1/100th% in interest. That's not slow growth. That's a guaranteed annual loss of about 3.4% of your purchasing power. Locked in, delivered on schedule. With a mobile app and a friendly push notification. This part breaks people's brains a little. Your savings account can be 100% safe and still lose you money. Those aren't in conflict. Safe means the number on your screen never drops. It says nothing about what your number buys. Silas figured that out at 33. He is not a genius. He read one page. So let's do this properly. Let's take Chelsea's $41,000 apart, line by line, and find out what it's actually costing her. She spends $3,400 a month. Run your own number here as I go. 2 months in checking puts her at $6,800. That's your first bucket. Fine, she wants 4 months of emergency savings. That's $13,600. In her account, at 1/100th of a percent, your $13,600 earns you $1.36 a year. Moved to a high yield account at 4.2%, it earns $571. Same money, same day access, same government insurance, run the subtraction. 6,800 plus 13,600 is 20,400. Chelsea has 41,000, which leaves $20,600 with no job at all. That's the number that matters, and it's the one you should be hunting for in your own accounts tonight, not your balance. The part of your balance with no assignment, no deadline, and no reason to be where it is. Watch what happens to it. $20,600 left alone for 20 years at 1/100th of a percent grows to about $20,640. 20 years, $40. The same amount at 4.2% becomes about $46,900. That's a gap of roughly $26,300. But that's the polite version, because we haven't touched inflation yet. Run that $20,600 forward at 3.4% inflation. In 20 years, it buys what about $10,500 buys today. So here's the real ledger, and this is the one your bank will never show you. Chelsea keeps every dollar. Her statement never shows a loss. She ends up with half the house she started with. Nobody took it from her. There was no fee, no scam, no bad quarter. She just left it somewhere. Lorene's $400,000, by the way, is doing the same thing right now, and in her case, that's fine, for reasons we'll get to. And Silas, with the identical balance and the identical habits, ends that same 20 years about $26,000 ahead of her. He didn't earn more than she did. He didn't save harder. He moved his money once on a Sunday and then went back to his life. And I want to be careful here because this is where finance channels go off a cliff. Chelsea isn't lazy. She isn't bad with money. She has $41,000 saved, which puts her ahead of most of the country. She did the hard part. She did the hard part inside a container designed to take a cut, which raises the only question that matters to you. Why is your gap that big? Not 5% bigger, 400 times bigger, for a product identical to the one you already have. Your bank is not a vault. Your bank is a spread business. You hand them your dollar, they pay you almost nothing for it. They lend your dollar out at a much higher rate, they keep the difference. You supplied the money. You carried none of the upside. That difference has a name. Net interest margin. Across the American banking industry, it currently runs a little over 3%. So on Chelsea's $41,000, her bank earns somewhere north of $1,200 a year. Her cut is $4. That's not a partnership, that's a parking garage. Whatever your balance is, that same arithmetic is running on it right now without your input because you gave your permission the day you signed up. There's a second mechanic, and it's elegant in the way a bear trap is elegant. It's called deposit beta. It measures how much of a Federal Reserve rate move actually reaches your account. When rates climbed hard, the big retail banks passed almost none of it to you. Your savings rate crawled. When rates started falling, those same banks cut what they paid you fast. Slow on the way up, quick on the way down. That sounds like a conspiracy against you. It isn't. It's just what happens when a business learns that you won't leave. Because the entire strategy rests on one documented behavior. The average American keeps the same checking account 19 years. The same savings account 17. Almost 2 decades of loyalty to an institution that pays you $1 a year and would replace your account number without noticing. Chelsea has been at hers since her first job. Silas was at his for 11 years before he moved, which is worth saying out loud so you don't picture some guy who had this figured out at 22. He didn't. He was you for over a decade. If you've been at your bank since your first job, drop the number of years in the comments. I genuinely want to see the range on this, and roughly 82% of Americans don't use a high yield savings account at all. Ask them why. The top answer isn't distrust, it's that they didn't know, then that it seemed like a hassle, then that they were busy. That's the moat. Not fees, not contracts, not lock-ins. Three answers that all mean I meant to get around to it. If you just recognize yourself in one of them, that's the entire point. Meanwhile, the money that reads its mail has been leaving for years. Money market funds now hold a record $7.9 trillion. Sitting across from that is roughly $19 trillion in bank deposits, much of it earning under 0.5%. Two enormous piles of American cash. One of them read the rate sheet. Silas is in that pile now. Chelsea still isn't, and she has no idea there's a second pile. Now let's go up to the famous ceiling. The one Lorene is sitting well above, $250,000. The exact phrasing is the whole ballgame. It's $250,000 per depositor, per insured bank, per ownership category. Most people hear the first part and stop, so take the pieces one at a time. The difference between understanding this and half understanding it is the difference between being covered and being surprised. Per depositor means you, the human, not your account and not each of your accounts. Per insured bank means the institution, not the branch you drive to. And per ownership category is where this starts working for you, because there are 14 of them and they stack. Run this against your own accounts while I say it. If you're married, you and your spouse at one bank can be covered for $250,000 in your individual account, $250,000 in theirs, and $500,000 in your joint account, because a joint account insures each of you to the full limit. That's $1 million of your money. One bank. Before you get clever, add your retirement accounts and it climbs. A payable on death account extends your coverage per named beneficiary, so naming 3 gets you $750,000 in that category alone. Now the misunderstanding that actually costs people money. Opening a second savings account at your bank in the same category adds you 0 additional coverage. 0, your balances get added together and measured against one limit. 2 accounts. One ceiling, it's the most common mistake I see, and it's an honest one. It feels like it should work. 2 buckets, twice the water. That's just not how the accounting runs. Chelsea has 3 accounts at her bank and assumed for years that meant triple protection. She was never close to the limit, so it never cost her a cent. It's just a clean illustration of how confidently wrong a reasonable person can be about their own money. What actually adds your coverage is a different ownership category or a different bank. 3 banks, 3 separate limits, and you didn't need a lawyer to do it. And what you're not covered for is worth memorizing. Stocks, bonds, mutual funds, money market funds, crypto, annuities, life insurance, whatever's in your safe deposit box. FDIC insurance covers your deposits. It does not cover things you bought while standing inside a bank. So does any of this matter? Or does the government just turn up with a fire hose of money? In March of 2023, Silicon Valley Bank went down in the fastest large bank run in American history. Here's the number that reframes everything. According to the Federal Reserve's own report, about 94% of that bank's deposits were uninsured. 94%. An entire institution built out of money sitting above the line, and the names caught in it weren't naive, which is the part you should sit with. Roku disclosed roughly $487 million stuck there. That was about a quarter of the company's cash, filed the same day. Roblox had around $150 million. Circle, behind a major stablecoin, had $3.3 billion parked there. Over that weekend, a token designed to be worth exactly $1 traded down to about 87 cents. A payroll company called Rippling liquidated $130 million in funds and raised $500 million in emergency financing inside about 12 hours, purely so that other companies' employees would get paid on Friday. Then regulators invoked the systemic risk exception. Every depositor was made whole. The FDIC absorbed roughly 16.7 billion in losses, then clawed it back through a special assessment on other banks. If you had money there, you got all of it. So the story has a happy ending, which is exactly why it's dangerous to you. The regulators who did it said out loud that it was extraordinary. They said you should not plan around it happening again. It was a discretionary call made over a weekend by people under enormous pressure. It is not in your coverage, it is not owed to you, and it's a genuinely strange thing to build your household on. Here's the honest version, because I'm not trying to scare you into anything. Uninsured depositors have avoided losses in the large majority of bank resolutions. The FDIC usually gets you access to your insured deposits inside 1 or 2 business days, so your odds of actually losing your money are small. But small and zero are different words, and you don't get to pick which one applies to you. Lorene, with $400,000 and a closing date 6 weeks out, cannot afford to find out which one she gets. There's also a second cost nobody prices in. Time, because here's what those 2 days actually look like. It looks like refreshing the same screen at 6 in the morning. It looks like standing at a gas pump with a full tank and a declined card. It looks like drafting a text to your landlord, deleting it, and drafting it again. It looks like calling a number and hearing a recording that says they're experiencing higher than normal volume. It looks like doing arithmetic in a parking lot about which 2 bills can survive being late. It looks like telling your kid that the trip is still happening, probably, and then sitting in the car for a minute before you go inside. Your money isn't gone, it's just not yours this week. If this is landing, come hang out in our school community. It's where I post the rate sheets and account structures I actually use, and where people work through this without anybody trying to sell them an annuity. Now, this is the part where you'd expect me to tell you to strip your accounts to nothing and shovel it all into the market. So let me argue the other side, because Lorene is about to prove there are real reasons to hold more cash than the spreadsheet says. The spreadsheet doesn't get startled. You do. You, knowing 6 months of your expenses are covered, don't panic sell in a downturn. Silas will tell you the only reason he can leave his investments alone through an ugly quarter is that he never has to touch them. That's entirely because of the boring, deliberately oversized pile of cash he keeps. Avoiding one panicked sale can outweigh a decade of interest differential. That's not a soft benefit to you. That's a return. Second, 3 to 6 months is a goal, not a diagnosis. Research on household cash buffers found you need roughly 6 weeks of take-home pay in liquid savings. That's to absorb an income dip and a spending spike landing in the same month. About 65% of families don't have it. For a middle-income household, that gap runs around $3,000. Third, the rules change depending on who you are. Variable income, self-employed, or the only earner in your house. 9 to 12 months is defensible. I won't talk you out of it. You know your own volatility better than any rule of thumb does. Retired? 1 to 3 years in cash and short-term bonds is a deliberate strategy. It exists so a bad market early on doesn't force you to sell stocks at the worst possible moment. And then there's Lorene. Lorene has $400,000 in one bank account, and she's right to. It's a house down payment. She closes in 6 weeks. That money has a job and a deadline. It can't be in the market because one bad quarter costs her the house. She has exactly one problem to solve. $150,000 of it sits above the insurance line. So she splits it across 2 banks, or uses a joint category with her spouse, or uses a deposit network service which spreads a large balance across dozens of banks in sublimit slices while she deals with one institution. Lorene isn't breaking the rule. She's showing you what the rule is for. Your cash isn't good or bad. Cash is a tool with a job description. How much you hold is a function of the job you gave it, not a number somebody put in a headline. Lorene gave hers a job, Chelsea never did. So back to the answer. 2 months of expenses in checking, 3 to 6 months of essentials in a high-yield account, a money market fund, or treasury bills. If you're in a high-tax state, look hard at treasury bills. Because that interest is exempt from state and local income tax. $250,000 as your hard ceiling per bank, per ownership category, and anything with no job for 5 years or more doesn't belong in a deposit account at all. That last one deserves a sentence. Leaving your long horizon money in cash means you're choosing a guaranteed small loss to avoid a possible one. You would never take that trade if somebody described it to you in those words. You're taking it right now because nobody has. Here's what I actually want you to keep. The reason Chelsea and Silas ended up so far apart has nothing to do with intelligence, income, or discipline. They saved identically. She treated her bank account as a place money lives. He treated his as a place money passes through. That's the entire difference between them, and it's the one thing in this video you get to change today from your couch in about 11 minutes. 19 years is a long time to be loyal to an institution that was never loyal back. I say that with no drama at all. Loyalty was never on the table. It's a spread business, doing exactly what it said it would do on a page you didn't read. Quick disclaimer, and I mean it. I'm not a financial advisor, and this isn't financial advice. Rates move, and every number here has a shelf life. Check the current figures yourself before you move anything. Now, that question I promised you. Here it is. Open your account tonight, find the interest line. Look at what last month actually paid you. If that number is smaller than a cup of coffee, you now know exactly why. And you know it wasn't a mistake anybody made. It's a ceiling. You're the only one who can raise it. If this was useful, subscribe and come find the rest of us in our school community. See you in the next one.